Imagine spending $500 million a year, private jets, mansions, anything you want. And at the end of that year, you legally owe less income tax than a school teacher. Not because you cheated, not because of some secret offshore account, completely legally. That's not a hypothetical. It's exactly how the wealthiest people in the world operate. And once you understand how it works, you'll never think about money the same way again. Most of us learned the same simple rule about money. You earn it, you pay tax on it, you spend what's left. If you earn more, you pay more. If you earn less, you pay less. The cycle is the same for everyone. It just happens at different scales. It feels universal, like gravity, like something that applies to every person equally, no matter how much they make. But it doesn't. Here's the thing about the ultra-wealthy. Most of them don't have large salaries. They don't earn millions in wages every year. Their wealth is locked inside assets. Shares in companies they founded or invested in. Real estate, private businesses. And here's where the problem starts. If you own $1 billion worth of stock, you can't spend a stock certificate. You can't use shares to pay for a house. At some point, you need actual cash. So what do? You sell some shares. But the moment you sell, you trigger something called capital gains tax. In the United States, the top rate is around 24%. On a $1 billion holding with almost no original cost, that's nearly $240 million owed to the government, just for accessing your own wealth. That's not a rounding error. That's a $240 million bill simply for spending money you already made. So the wealthy looked for another way. And they found one. Instead of selling, they borrow. Here's how it works. You walk into a private bank. You own $1 billion in stock. The bank looks at that stock and says, "We'll lend you $500 million against it." The stock stays in your account. You keep all the upside. And you walk away with $500 million in cash. Now, is that cash income? No, it's a loan. Loans are not taxed. You owe the money back eventually, but right now, you have $500 million and a tax bill of exactly zero. Meanwhile, your $1 billion of stock keeps compounding. It grows while you live on the borrowed cash. The asset works for you. The loan costs you maybe 2 or 3% interest per year. The stock returns far more than that. And this isn't theoretical. Elon Musk takes no salary from Tesla and has borrowed against his shares rather than selling them. Jeff Bezos has drawn the same roughly $80,000 Amazon salary since 1998, while over $200 billion of his wealth sits in Amazon stock, untouched and untaxed. And Oracle's Larry Ellison went almost a decade without selling a single share, yet kept spending the whole time. He even bought a Hawaiian island for $300 million, all funded by a multi-billion-dollar line of credit borrowed against his Oracle stock. The salaries are almost a decoy. The borrowing is the real engine. This is not a loophole someone discovered by accident. Wealth managers have a name for it. They call the full strategy buy, borrow, die. And the reason it has that name is because of what happens at the end. Because the obvious question is, doesn't the tax bill catch up eventually? You borrowed against the assets, you lived on the loans, but at some point you have to repay the banks, and repaying requires selling, and selling triggers capital gains, right? Not if you die first. When assets are inherited, something called the stepped-up basis takes effect. It's a rule that has been in the United States tax code since 1921. Here's what it means in plain terms. You buy stock for $10,000. Over your lifetime, it grows to $1 million. You die. Your heir inherits that stock. But in the eyes of the tax code, they didn't inherit stock that was originally worth $10,000. They inherited stock worth $1 million. That's their new cost basis. They sell it immediately. Capital gains owed? Zero. The loan gets repaid from the estate. The interest was manageable, and the $990,000 in gains that accumulated over an entire lifetime, the gains that were never sold, never taxed, borrowed against to fund a life of luxury, are permanently erased. Not deferred, not passed on, gone. Never taxed by anyone, ever. That's the complete picture. Buy, borrow, die. In 2021, ProPublica published a major investigation using leaked IRS data. It revealed that the 25 wealthiest Americans paid an average true tax rate of 3.4% over a recent multi-year period. For context, the median American household earns about $70,000 a year and pays roughly 14% in federal taxes. The 25 richest paid a true tax rate of 3.4%, a fraction of what the family down the street pays on a paycheck. The strategy doesn't require breaking any laws. It doesn't require offshore accounts or secrecy. It requires assets, a relationship with a private bank, and a tax rule that has existed for over 100 years. Why hasn't it been changed? The stepped-up basis is not a new discovery. Congress has tried to reform it multiple times, including in recent years, and it has failed every time. Part of the reason is that the rule wasn't created for billionaires. It was designed to protect small business owners and family farms, people who build something over a lifetime and want to pass it to their children without forcing a fire sale just to cover a tax bill. The other part is that the arguments on both sides are genuinely complicated. Critics point out that ordinary workers pay income tax on every dollar they earn, while the ultra-wealthy can accumulate billions and ensure those gains are never taxed at any point. Defenders argue that the assets were already subject to estate taxes, and that removing the stepped-up basis would create enormous administrative complexity. This has been an unresolved debate for decades. Now, can you do this? The mechanics are the same for anyone with significant assets. Home equity lines of credit work on the same principle. Borrow against your house instead of selling it. Margin loans let investors borrow against their stock portfolio. But the terms are very different. A billionaire borrowing against a diversified portfolio of blue-chip stocks pays 1 to 2% interest at a major private bank. A retail investor borrowing on margin might pay 7 or 8%, with strict limits on how much they can borrow before the broker forces a sale. The strategy is legal for everyone, but the version available to the ultra-wealthy, where you borrow at rates below inflation, against a portfolio so large and diversified that no single market move can force you out, that version requires a level of wealth that most people will never reach. Most of us grew up believing taxes were the price of success. Earn more, pay more. That seemed fair, or at least consistent. What this video has shown is something different. Above a certain level of wealth, the rules of the game change. Not through evasion, not through dishonesty. Through a legal architecture that allows gains to accumulate, be borrowed against, and, at the right moment, disappear entirely. Whether that system is fair is a question only you can answer. But now you know it exists. Defenders say it rewards the risk-takers who build the economy. Critics call it a legal scam. So which is it? Brilliant financial planning? Or proof the tax code is fundamentally broken? Tell me in the comments.